You take over, buddy.
Awesome. And everyone, make sure you tune in next week. Chris is going to give a rundown on his health and what's going on.
I did play tennis last night. It's the wing's a little sore.
I love it. I love it. Well, hey, good morning, everyone. And Chris, Melinda, and really the entire team at GP, thanks for the partnership. And, not only with today's call, but really what we've built over the past 12 months since we launched this new distribution channel that we talked about last week. So what we're going to do today is I'll just give, a 30,000-foot review of what we talked about last week. So if anyone's on today's call that missed some of the things we talked about last week, let's circle up. Let's make sure we connect. But today's presentation, we're going to focus on accumulation. But just like we did last week, I want to make sure that everyone kind of understands, hey, as we go through this, ask questions. Let's make this as interactive as possible. And to do that, let's go ahead and start. You've got the Q&A on your Zoom software here. So I want to make sure that everyone kind of knows where it is. So to start off, we'll do the same thing we did last week. We're going to start off with a trivia question. The first person to answer the question correctly will receive a Yeti thermal cup. So in 1992, Keanu Reeves starred in a movie that highlighted him as an FBI agent specializing in bank robberies in the LA County area. What was the name of Keanu Reeves' character, excuse me?
Yeah.
Character. I didn't finish the question. So what was the name of his character?
His character.
His character. I remember Patrick Swayze was in that, right?
Yep. Patrick Swayze was Bodie. So the name of Keanu Reeves' character.
No Googling.
I think Tom said, I'm going to give it to you. So Tom came in hot with two answers. First, he came up with Point Break. Jonathan's not Speed. It's the movie Point Break. And the correct answer is yes, it is Johnny Utah, the punk quarterback from Ohio State. So Tom, we'll get you out that Yeti cup. So, but moving forward, if anyone has any questions, go ahead, type them into the chat. Melinda, please keep me honest. In case I don't see something, just kind of go ahead and shout at me. So, all right, let's hop into today's content. So, Chris, is the screen showing up the way it should?
It is, but those questions keep popping up on the screen. So there we go. Hopefully,
sorry.
Yeah, you look good. It's good.
Okay, cool. All right. So, like I mentioned, today what we're going to focus on is whole life within the accumulation strategy. All right. Last week, we gave an introduction to whole life and some of the high level points we talked about, kind of demystifying the dividend, right? This black box is no longer. So if you want to spend a little bit of time understanding that, please let us know and we'll review. Also, compensation, right? Compensation being more favorable for whole life over the 10-year duration compared to some of those UL contracts that are available. And then the third point to just kind of summarize, this is a newer distribution model that's really only 12 months old. And so through the team at GP Agency, you are now able to have a direct contract to MassMutual home office versus going through a career agency where you would have a contract with that agency versus a contract directly through home office. So what we're going to talk about today is, why whole life, why now? We'll hit a little bit about the environment, why we need to actively be holding these conversations. We'll talk about the difference in accumulation, delivering on our commitments, talk a little bit about the interest rate environment, what effect that's having from a whole life perspective, but also on IUL. We'll walk through 2 accumulation case studies. We'll hit again on that compensation, and then we'll just give a high level of some of the resources that we have from an advanced sales perspective.
Hey, Matt.
All right. Now, yeah.
I've got a question. Someone's asking if MassMutual is a New York licensed company.
Correct. Yeah. Yeah, we are a New York domiciled company. Yep.
And one more question, I'm sorry. Can we transfer agency written business to the new brokerage side?
So let's take that one, John, let's take that one offline, because that's going to depend. I always hate the answer. It's going to depend on the case, but it's something that that we'll have to talk about because it's a little bit more of a complicated answer.
And typically, wherever it's written, it's got to stay. Just for the short answer on that one. So
Right.
it's a mess to even try to switch it over anywhere else. So, but you
Yeah,
keep the old contract, you keep your renewals, keep it going like it was before, and then you just have a new contract for any new business going forward.
That's exactly it. Yeah, and I didn't want to get too deep into that, but Chris, since you hit on it, so we actually want to maintain dual contracting. Okay, so you want to keep your current contracting over there, then obviously start new contracting on the MMSD side, just because we don't want those policies to become orphan. One note I will make is that if there is a term policy that is available to be converted, you all have the ability to convert that product without a reduction in compensation.
And FIOs on the DI side and stuff like that. So yes, all right.
Exactly. And thank you, Melinda, for stopping me. So, with whole life, really whole life, I don't want to say was saved, but received kind of some favorable, I guess, change within the tax code. And that came at the end of 2020 in the Appropriations Act, where in tax code 7702 has made it more favorable from an accumulation standpoint for whole life. It's made it where from a traditional sense, from a premium to death benefit, where the death benefit has become a little bit more expensive, if you will, but really it has become more favorable from a cash and income perspective, and we'll hit on that in a little bit. We've seen a little bit of pushback as it pertains to the IUL space and the reduction of caps, the introduction of proprietary indices, where a lot of those indices are uncapped. But if you look at kind of the breakup of those indices, a lot of times they're sitting heavily in cash or fixed income. So we've kind of received some of the interest rate pushback. Over the past 24 months, we've seen a reduction in limitations with certain guaranteed products. I can say at this moment, we do not have any limitations in regards to our base premium for any type of maybe larger case that you're looking to illustrate. But really the big bullet point is kind of that fourth bullet point, and it's the current financial environment, right? And depending on, where you're allocated, market volatility is extremely high right now. Many clients are hesitant to go into those markets because of that volatility. And then you also couple that with the interest rate environment, right? Nobody's necessarily going to want to buy a bond today that's going to be worth less tomorrow as interest rates continue to go up, right? So there is that concern from that perspective. And what it's done is it's resulted in nearly $7 trillion sitting on the sidelines. So to put that in a little bit of perspective, there is $3 trillion more sitting on the sidelines with your clients, sitting in savings, sitting in checkings, $3 trillion more than January of 2009 on the heels of 08, right? And those clients that aren't investing those dollars, well, they're probably not going to. So now we can introduce a strategy that is not tied to the market. It's got a positive correlation to rising interest rates, and we can guarantee every single dollar that they put into the contract. All right. We talked about this last week, but this should be used as a refresher. Whole life is very unique because of those three guarantees: guaranteed premium, guaranteed death benefit, and guaranteed cash accumulation. So on a worst case scenario, once again, you're protecting every single dollar that a client puts into this portfolio. You can go to a worst case scenario, the basic illustration within our illustration, and show them the worst case where they are breaking even in 17 years, 20 years. And that's assuming maximum mortality. And that's assuming MassMutual is never paying another dividend ever again. That second bullet point, I mentioned this on the prior page, cash value growth is not directly affected by market conditions. So this is an asset for some clients right now that is not dealing with the ebbs and flows of the market. This is an asset that in March of 2020, a client could have tapped into and given that retirement portfolio a chance to recover. Whole life is also eligible to receive dividends. Certainly dividends are never guaranteed. So there is a difference between a guaranteed cash value growth rate versus a dividend, right? So there is no minimum guaranteed dividend there is a difference there. So once again, dividends never being guaranteed, although MassMutual has a strong track record of Chris, I want to ask you, what's the track record on our dividend? You're pretty good at this.
How many years you've been given a dividend?
Consecutive. Yep.
What's it, 128?
154.
Wow.
Well,
Right around the time you were getting in the business, right?
no, we got a couple guys on the line there about that. Bill Widener, yeah, I pick him on Billy.
All right.
Anyway.
I love it. All right. So, and really these 3 bullet points are pretty much synonymous for whole life. Okay. So not necessarily just MassMutual. Now, when we look a little bit deeper into our portfolio, here's some differences on the MassMutual side. You see, life insurance not only grows tax deferred, but it can come out tax free because of a return of cost basis. And then once we've exhausted cost basis, we switch over to those loans, right, to maintain that tax free income. Here at Mass, we give the client the ability to choose at issue whether they want to have a fixed loan utilizing direct recognition, so they can lock in a fixed loan rate of 6%, or they can go with an adjustable loan rate that is currently sitting lower. Our 10-pay, the floor is 3, a 3% loan rate, and it's currently sitting at 3. That's tied to Moody's corporate bond yield. So obviously that number can go up as interest rates go up. So we do offer a client the choice to do that. So think of just as kind of a refresher or a reminder, you can either lock in a 6% loan rate, or you can lock in a currently lower rate that is going to be adjustable, or that will vary. A couple riders we're going to talk about today, and some riders that really make sense to kind of circle around and discuss with your clients. Number one, a rider that I always like to discuss is our waiver of premium. And I know that might sound a little bit odd, but not only is MassMutual competitively priced, okay, we are competitively priced for it to make sense, but Mass doesn't just waive the premiums. We actually add those dollars into the contract for your client. So if we're working on an accumulation case and the premium's $5,000 or $200,000, Mass will not just waive them, but we will add those dollars into the policy. What is also very unique about the rider is that it is 5 years own occupation depending on the state. So you should be familiar with the story, but if you're not, but think of that one surgeon, right? He's not able to operate, or she's not able to operate, but they can go teach at NC State, right? That's a prime example of the own occupation, whereas maybe their income's gone down, and Mass is going to apply that in for the next 5 years for the state of North Carolina. Anything beyond that is total disability. All right. Additional life insurance rider, we typically use that to kind of overfund the policy in the earlier years. If a client may want to pay for 4 years or for 5 years, we may use it at that point. Our life insurance supplement rider, this is our LISR rider. We will typically use this if we want to blend in term to try and either increase that dividend or maybe reduce the out-of-pocket premium. Typically with an accumulation case, we normally come in saying, hey, a client wants to allocate, $5,000, $10,000 to this strategy. So we don't normally, kind of approach it from a death benefit perspective. And I think that's an important item to note, is that, a lot of times as we're approaching the accumulation strategy, we don't want to say, we're going to show them $1 million. We're going to show them $1 million worth of death benefit, because when we show an even $1 million, what does that do? In the client's mind, it creates an expense. See, we're already training then the client to go, oh, $25,000, that sounds expensive. Whereas we have to look at this strategy the same way we look at allocating dollars towards whether it's a savings account, whether it's a qualified plan, right? I'm not putting those in the same category, but you don't sit here and say, oh, I've got to put away, $19,000 or $19,500 into my 401k this year. You don't look at it like that. You look at it, do I have potential to put more? What can I do? And that's the same way we should look at this strategy.
Well, one thing I want to note, though, so that our agents aren't upset here, is the AILR and the LISR have a reduced comp, if you're not aware of that. So base comp is going to be high as what you used to, 50 to 70%, whatever. But these are like 2 to 3%, the riders, when you put them on there. So if you blend a lot of it, it does dilute the comp quite a bit.
Yep. Absolutely.
Sorry, I had to throw that in there. Tom Gervais Tom's got a couple of questions.
Yeah,
how
I got
much
this now from Thomas. Yeah, so up to 90%, and we can actually borrow as early as year one, Thomas. And second one, can you review direct versus indirect loans? Yeah, absolutely. Okay. So with a fixed loan, I mentioned this, you have the ability to select direct recognition. Okay. Now, what that means is when a client takes a loan from this policy, sure, they are going to have that fixed loan rate of 6%, but MassMutual is going to credit a lower percentage of our dividend on those loan dollars that are outside of the contract. Okay. It also affects some of our outside business earnings, or how those outside business earnings are credited onto the policy, which we talked about that a little bit last week. The adjustable loan rate. All right, sure, you've got the potential for that to increase based on Moody's corporate bond yield. We move it every time Moody's adjusts more than 50 basis points. But MassMutual is going to credit the same percentage of our dividend on those dollars, whether they are in the contract or whether they are loaned out. Okay, so non-direct recognition, we will credit the same amount of our dividend on those loan dollars. Direct recognition, we will credit a lower percentage of our dividend. Okay.
So like
a lot of time,
the quiet company's direct recognition and all of that. So they don't like their clients to pull out money out of any of their contracts. So if you ever in a competitive competition there, you want to show, let's say, putting premiums in for 15 to 20 years with Mass versus that other carrier, and then say, stop drawing out income, how much better MassMutual will look. So no question about it.
That's right. And so that's a competitive advantage. A lot of times you won't see income coming out of other contracts, other whole life carriers, for whatever reason or another they come up with, kind of like the Coca-Cola thing that Chris mentioned earlier. But it is a competitive advantage to pull income. Other mutual companies have an 8% loan rate. Ours is 6%. And those are, on the fixed loans, right? Additionally, where we are seeing a lot of activity are some clients that may have Ohio national policies. We're seeing kind of a lot of those dollars flowing in right now. So just kind of keep that in the mind as well. So moving along, and I want to make sure we get through today's content. So we've got 6 individual whole life contracts to choose from. 7 if you include our survivorship whole life. And what you'll see here is we've got them laid out from left to right, illustrating our more accumulation focused product. Our 10-pay is going to have the best internal rate of return from a cash accumulation standpoint. This is going to be that high income earner that is looking to really maximize those the funding for 10 years. Just over to the right, you've got our 15, 20, and pay to 65. This is more of a balanced portfolio. So think of that client that really needs that higher death benefit, and they also don't have the ability to put away as much as they could within the 10-pay, right? Maybe they need to stretch it out over a longer duration. So we see that as more balanced. And then all the way to the right, that is our whole life 100. That is a really pinnacle of our portfolio, because it gives the client the ability to fund, all the way up to age 100 if they would like, and still provide them with some cost-effective death benefits. So once again, from left to right, you've got more accumulation focused, all the way over to our pay 100 that's going to leverage some more in death benefit. We'll talk more about that product next week during the.
Hey, 1 second, Matt. I want to hit on that though, Matt. If you go back.
Yes, sir.
If a lot of those folks out there write juvenile policies, and if you've compared Mass versus anybody, they kill them right now. So if you got the grandparents that want to pay for the next 10 years, 15 or 20, whatever, for their grandkids, give the gift from the grave. It's a great, you can show them the 10, 15, 20, put $100, $200 in a month. And then when that grandchild is 60 or 70, you wouldn't believe how many millions are in that thing. The other thing we overlooked is that HECV, that high early cash value. We sell a ton of this thing. It's basically you put in $10,000, you have $9,200 in cash guaranteed at the end of the first year, or as soon as you put it in. And then after about 3 years, you're guaranteed about 99% of the cash in. It was great in 2007 when I had a lot of builders, and Matt, you might want to put on the earmuffs here, but I had a lot of builders say, hey, I got 400 grand. I need to dump it into something that's protected from creditors. Can I drop it into this whole life policy? And I had a bunch of deposits going in, single premiums. they didn't care it was going to mech because 10% was better than them losing all their money the next month or 2 months when it was really going to run out. So who knows what's facing us coming here in the future if we have a crash in certain things. But think about that HEC V there. It's great for smokers. If somebody, tobacco user, just if you could break down a term case versus a HEC V and you show a term smoker rate versus a HEC V smoker rate, it's a lot more premium than HEC V, but at the end of the first year, you're way ahead of the game that you could still pull your cash out too. So there's a lot of interesting things you can do within this portfolio. Sorry, Matt, stealing some of your thunder here, buddy.
No, you're good. You're good. No, I appreciate it. All right, so moving along, and I know we're kind of creeping up. We got about 6 minutes left, so we're going to kind of go a little bit faster through some of this information. So what we've got here is a breakdown of our dividend interest rate, our DIR, from 1980 until today. The reason why I always like showing this is because it's simple to say, you know what, whole life carriers are a thing of the past, dividends are low, but look a little bit closer. You'll notice that from 1980 really until 1987, our dividend has increased, or it increased over that duration. Now, if you look at interest rates from really 89 until where we are today, they've been on a consistent decline. But if you remember back in 2013, we saw a small bump, or a slight bump, if you will, in interest rates. And the reason why I always hit on this is because when MassMutual has the ability, right, given the environment, to increase our dividend, we've done that. Okay, and I think it's important just to hit on that. And so from last year to this year, our dividend was 6%. But remember, this is just the dividend interest rate. It's a big part of the story. It is not the entire story. Okay, it is also tied to mortality and expenses. Remember, mortality last year to this year was favorable. So our illustrations look better, even though our dividend stayed at 6%. Okay, so just always kind of keep in mind that you can't sit and say, hey, whole life policies haven't performed, interest rates are down. And here's a prime example of why you can't say that. Here's a policy taken out in 1980. It was taken out on a female age 35. She had a death benefit of $250,000, payable, guaranteed cash value as well, and then a guaranteed premium of $4,000 to age 65. So all the guarantees we talked about: premium, death benefit, cash accumulation, and the policy is participating just like all of our products are available today, meaning she's eligible to receive that non-guaranteed dividend. And Chris, once again, how many years in a row?
158?
Oh, 54.
Oh, shit.
58 sounds better though.
Yeah.
So what we did on this slide is we just wanted to pause and we said, hey, let's take a look at where we illustrated this policy cash value to be in 2021. So when she took it out, where we anticipated it to be in 2021 versus how the contract is actually performed. Now, remember, interest rates are down, dividend interest rates are down, interest rates are down. So these policies don't perform, right? Well, if we look at that cash value sitting at the end of 2021, we assumed, or not assumed, we illustrated that she would have $449,000 when in fact she's got $614,000 worth of cash. So the policy has significantly outperformed by 37%. And for this client, when we talk about March of 2020, this is an asset that client could tap into, and the net internal rate of return of 5.81 on that cash value. So what other avenues out there today that can equal the same type of yield for a client in retirement? There's not one. All right. So when you sit and say whole lives don't perform, not the case. Now we'll touch a little bit on index products, and I know that many of you are familiar with this, so we don't have to spend a lot of time. But in reality, as an industry, we've been feeling the pressure from the cost of purchasing options as well as interest rates. You can see here some of the larger carriers: Pac Life, Lincoln, Minnesota Life, and John Hancock, all have dropped their caps significantly. John Hancock, what is that? 34%, Lincoln 37%, Minnesota Life 43%, and John Hancock a reduction by 26%, really just over that last 10 years, right? So limiting the upside for our clients to be able to capture. So to take that a step further, let's look at a case design, and we'll compare MassMutual versus an industry leading index. We've got a male age 45, putting away $200,000 for 10 years. Death benefit day one, 2.8 million. Concerned about income protection, mitigating taxes, supplementing retirement, right? That is the wheelhouse. That is the ideal client for this strategy. And high income earner, I mean, that's going to be relevant to lifestyle and where you reside, right? If you've got a doctor making $1 million, spending $1 million, that's not the right client. So you also want to focus on that, those strong savers. Now with this case design, $200,000 going in for 10 years, reading from left to right, the guaranteed cash value, that's where whole life is going to separate. 1.9 million versus an index product, the guaranteed cash will be 582,000 at age 65. That's assuming maximum charges on the IUL. That's assuming a minimum crediting rate or growth rate, interest rate, whatever you'd like to call it. Is that realistic? I wouldn't say so, but it's the worst case scenario. You'll notice at age 65, MassMutual's cash value is just below 3.6. The IUL is at 3.7. Now, the big difference comes in where IUL is able to separate from whole life is within the income. You'll notice that Mass's income is 378 versus 429,000. After all of those distributions have come out, we have a remaining death benefit of 268. They have one of 177. Many folks will argue, you know what, Matt, we're doing this for income. Death benefit is at that point in time isn't a major concern, and I think I would agree. All right. But to take it a step further, MassMutual's dividend over the past 10 years has dropped roughly 15%. Okay. So what we've done on this bottom portion here is we've assumed that our dividend's going to drop that roughly that 15% to a 5.25. Now we're also going to assume that IUL cap continues to reduce by that 26%. Of course, the guaranteed cash will be the same, but where you start to see that big difference is in the non-guaranteed cash accumulation, non-guaranteed cash value at 65. Ours goes down by about 300 grand versus that IUL going down by $1 million. Our income's 298,000. That index, 212,000. Now, the reason for bringing this up is not to tell you, hey, stop selling IUL, but it's really to highlight that this is that conservative bucket for the client. Is the client coming to the insurance company to take on more risk, or are they coming over to mitigate that risk? Right? It's clear that you can see which one is going to be more volatile or subject to more risk if rates continue to stay low or maybe even go lower. All right. Check time. So, hey, Chris, we're a little bit over. Is that okay if we keep pressing through?
You know, if people got to go, they got to go, right?
Yeah.
Tom's got one more question there. So
Can you see it, Matt?
the non-direct is better if you want to pull money out over time?
Yeah, so one, it's going to always depend on the client's risk tolerance, right? Whether they want to have that fixed loan or not, or they're okay with adjustable. Which one's going to show more in an illustration? The adjustable loan rate, of course. Now, the point that I always make is that while interest rates, of course, they look as if they're projecting up. So naturally, you would assume that loan rate is going to continue to move upwards at this point in time, right? I also bring up the fact that historically our dividend increases as well. I could say majority of the policies that we place have that adjustable loan rate because of the fact of the positive correlation of our dividend, that eventually our dividend should increase as well. But once again, it's going to come down to client risk tolerance. But from an illustration perspective, that's the case. What I have heard, I'm cautious to mention this, but Mass is actively looking to be able to implement the fixed or the variable loan rate and the fixed loan rate at time of loan instead of at issue. right? So give a client the flexibility at the time. I know we're a long ways off, but just know it's something that's in the discussion, right? So you can make that decision depending on where the loan interest rate environment is versus, 20 years prior. Okay. All right. In front of you here, this is actually, Tom, this will address or kind of hit on that direct versus non-direct and that loan rate that you mentioned. Illustrated on the left side, that's with our adjustable loan rate. Those are all the same numbers we just talked about on that IUL comparison. The column just to the right, that is with the fixed loan rate. So where you're going to see that difference is going to be at the annual distribution, the third row up. You'll notice we go from 378 to 324,000 with that fixed loan rate. Our total income goes from 7.5 to 6.4. The net IRR is still a 4.37. Last time I checked, a 30-year muni was sitting at about a 1.6, 1.7. Okay, so very attractive. The middle row, 10-pay short pay with a 10-pay short pay with RPU. All right, just flows off the tongue. It sounds like Chris Kerrigan came up with that one. So what the client's doing here is they're funding $200,000 for 7 years. Now, this can be decided at time of issue that, hey, we're going into this with the mindset of funding for 7 years. Or the client may say in year 8, you know what, hey, I just can't fund anymore. I'm illiquid or I don't want to, whatever the reason may be. So what we're going to do is after the 7th year, in year 8, we are going to illustrate a guaranteed paid up. That means we'll take a reduced death benefit amount, guaranteed no further premium, and that cash value is preserved. Okay, it will never go down unless, of course, we take distributions out, and the policy is still eligible to receive dividends. Client pulls out income from 71 to 90, they're pulling out 273,000. 10-pay with distribution. You'll notice that we fund in 200K for 10 years. But you'll notice in this one, we've got a row that has 2 million. What we assumed here is that the client says, you know what, Matt, when's the soonest I can take all of my money out that I put into it through a combination of withdrawals as well as loans, continue to have coverage, and then from 71 to 90, pull out income. So they take their 2 million back. They still have net distributions of 149,000, total distributions coming out of 4.9. So a lot of times people will look at this from a financing perspective, or simply just when's the soonest I can access, not necessarily a return of premium, but when can I get the dollars back out that I put in? All the way to the right, that's our 10-pay with the adjustable loan. So it's the same case that we did on the far left, the same comparison that we did for the IUL, but this time we're including that waiver of premium. Here's the cost. Our $200,000 premium will stay the same. Our death benefit will go from 2.8 to 2.7. Our income from 71 to 90, 377,000. So we're going to take about a $1,400 haircut 20 years down the road during income. Total distributions 7.5. Net internal rate of return 4.67. So that's what I'm referring to when I say it's priced competitively. I mean, if this individual here it's unable to operate, right, like we talked about, MassMutual is going to put those dollars in for the next 5 years of 200K. All right, so really a minimal cost to have that added layer of protection in there. Okay. Don't want to spend a lot of time on this slide, but what this does is this illustrates the flexibility of the portfolio, and it also highlights the difference between the 10-pay, the 15, and the 20. Remember, the 10-pay was the most accumulation focused, with the 15 and the 20 being more balanced. If we take that same $200,000 premium, you'll notice that the 10-pay death benefit in that first row is $2.8 million. You'll notice on the 15-pay, it is 4.5. Of course, there's going to be a higher target on those cases. Still, both of them are driving strong cash value accumulation, but ultimately the IRR, once again, on that 10-pay will be the best. But a lot of times folks go into this portfolio and they say, you know what, we think we'll fund for 10 years, but I'd really like the ability to fund for 11, 12, 13, 14, 15. So what we see clients do is go towards that 15. And then what they'll exercise if they don't want to pay anymore is they'll go 15 pay, reduce paid up RPU in year 11. So they'll fund in for 10 years. In the 11th year, they'll shut it down. They're still able to pull out that income, $338,000. So it's less than the 10 pay, but in the event they want to continue to fund, they have the ability to do so. So some clients like to have that flexibility, if you will. All right. Shifting a little bit into the compensation, here's how the compensation would work on that $200,000 premium case. The target is $66,000. The excess is $132,000. We pay 5% on excess in years 1 through 5. So you'll notice the total compensation in year 10, or at the conclusion of year 10, would be $132,000. So that's a big part of the story. Okay, we cannot just focus on year 1.
And that's just the base comp. There's additional ERA that we pass through.
Correct. That is street
levels. That's street comp. Yeah.
Here's a second example of this compensation. This is the example we talked about last week. If we're comparing our product to an IUL, $100,000 premium, this is different than the 200K one. $100,000 premium year 1, the IUL you will make more. 30,000 versus 21,000. But it is very important to see the entire picture. By year 3, that is your break even, and you will continue to surpass that comp on the IUL product from years 4 through 10. All right. Those years 2 through 10, a lot of people describe that to me as mailbox money, but it is significantly more in overall compensation. Okay. So really, that's it for the accumulation part. I know we went about 10 minutes over. We've got an outstanding team of advanced sales members that help support the team at GP. So whether it's split dollar, premium financing, or really just keeping Mr. Kerrigan in line, we've got a full team of people that are here to help. So
no, they're awesome. You have direct lines right to them. You hit the option 2, and then who's ever available at the time is there to take your call. So there's not many carriers that have this many, especially just for brokerage, so that you have direct access to. They don't typically like to talk to the client as well. They, you got to let them know or just feel them out a little bit, but that's case by case.
Yeah. I mean, we've got a great team. I know that we've obviously partnered in the past and had client calls. And our team doesn't skip a beat. So we're very fortunate from that perspective. And not necessarily, on the same topic of clients, but getting in touch with underwriters. Obviously Angela loves the accessibility to our underwriters, to be able to talk through cases, to be able to give the overall picture. And once again, I said this a lot last week, but this is a division that's dedicated to brokerage, dedicated to the team at GP, and dedicated to the success of all of you.
And Matt's been awesome. So what do we got? What's our next class?
The 19th.
2 weeks. And then the week after, we have a 1 hour CE on DI. Yeah. Since May is Disability Awareness Month, we want to hit that. And then we've got Boston Mutual coming in talking about worksite products. So a little bit of shift, and Cincy Life too. So we got a few lined up. But Matt's done an awesome job. Thank you, Matt. And if anybody wants these slides, we're happy to.
I'll send out.
Oh, she's going to send them out anyway.
Yeah, he'll have to send me the slides, but I got the video.
Okay, we got the video of the presentation. So Matt, once again, you're awesome. Thank you so much. And everybody have a great day.
Yeah.
All right.
Thank you.
Thank you, team.